Welcome back. In this video, I will discuss the calendar spread. A calendar spread consists of two legs. The first leg is a short option position. This position is usually taken in the current month expiry option. The other leg is a long option position, which is taken for the same strike price as the short option position, but the expiry day for this option is usually in the next month. So for example, on the right, you see a calendar spread created from put options. You see that we sold the 14,500 put option for April expiry and we bought the 14,500 put for the May expiry. So the strike price of both these options is the same, but they have different time to expiry. A calendar spread can be created using either a call option or put option. So for example, you could have used call options instead of put options here. So for example, this is a calendar spread that uses call options. You see that we sold the 14,500 call for April expiry and we bought the 14,500 call for May expiry. Now the strike price of both these options is the same, but their time to expiry is different. Now let's look at the payoff diagram for calendar spread. Here we have sold the 14,500 put for April expiry, while we have bought the 14,500 put for May expiry. Now the dashed line here shows the payoff for this trade as the expiry nears for the April month option. Here you see that the payoff will be maximum if Nifty is close to 14,500, which is also the strike price for both options. Your trade would remain somewhat profitable if the prices stay between the 14,000 to 15,000 range. The solid line here shows your immediate profit and loss when you initiate the trade. So if the prices were to move by 500 points either way from the current price, you will see a loss of around 2,000 rupees. If the prices don't move, then you are likely to accumulate some theta from the April month short put position. You will also lose some theta from your May month long put position. However, since April month expiry is nearer than the May month expiry, your gain from theta will be more than your loss from theta due to the May month long option position. As days pass, you will accumulate theta if the prices stay in the range such that the solid line curve will slowly converge to the dashed line curve. Ultimately, your profit when the prices stay in the range is shown here. Now the natural question is, in what kind of markets should you initiate a calendar spread? The calendar spread is best suited for a low volatility environment. In a low volatility environment, the prices are likely to stay range bound. If you explicitly have a view that the prices are going to be in a range for say next few weeks, and if you find that the volatility is low, then you can go ahead and initiate the calendar spread. You can execute a calendar spread for an option with the strike price in middle of your expected price range. For example, if you see that the IV percentile is less than 40% for this script and you expect that the Indian Nifty is likely to stay in a range of 14,000 to 15,000, then you can initiate a calendar spread by selecting a strike price close to the middle of this range. In this case, we have initiated a calendar spread by selling the 14,500 strike put and buying the 14,500 strike put. The next question is, when should you initiate the trade if the market conditions are met? Now the best time to initiate a calendar spread is when you are 3 to 4 weeks away from expiry for the short option position. Now during this period, the theta decay would start to kick in, and if the prices stay in a range, then you can expect that the theta will accumulate rapidly over time. When you initiate the trade, the price of the underlying should be close to the middle of the range. So for example, if the current price is close to 14,500 and if the prices are expected to stay in the range between 14,000 to 15,000, then you can initiate a calendar spread for this strike price. Now the next important question is, when do you close this trade? Now in terms of booking your losses, once your trade violates your market outlook, you should close your trade. So for example, here if your outlook is that the prices would stay between 14,000 and 15,000, then you can exit your trade once the prices violate these levels on either side. Now when it comes to booking profits, you can book your profits when the expiry for the short option position nears. So for example, Here we are short the 14,500 April put. So when the April month expiry nears, we can close both legs of our trade. So we will buy the 14,500 April put to square off the short leg, and we will sell the 14,500 May put to square off the long leg. Now by doing this, we will be able to book profits in our trades if the prices stay within our specified range.